Thanks for joining us on Power Lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon, I'm Meera Dugal. Let's get you the headlines. Indian markets remain volatile as investors prepare themselves for the first day of polling and corporate earnings starting later this week.
Asian Paints is the top Nifty loser today after CLSA downgrades the stock to sell from outperform. A fire at the company's Andhra Pradesh plant also hampers production.
IPL Fantasy League portal Dream 11 becomes India's first gaming unicorn.
US President Donald Trump threatens new tariff on helicopters, motorcycles, cheese and wine in retaliation to the aircraft subsidies given by the European Union.
All right, let's first take a look at how markets are faring. Yatin is here with us. Afternoon, Yatin.
Good afternoon, Meera. The markets are, on a flattish note this afternoon. Haven't seen much action and volume, both, which are missing in trade. Advanced decline ratio also pointing out that, the bears have control today. 2 advances for 3 declines as far as Nifty 50 stocks are concerned. What's gaining momentum in trade is Yes Bank, Tata Motors as well as Wipro. Along with Wipro, we also have HCL Technologies in the IT pack, which is doing well. So we have a few private sector banks and IT stocks which are doing well in trade today. Apart from that, as you mentioned earlier, Asian Paints is down 3.5% after we had a blast reported in one of their South India units. More importantly, today we have CLSA also, which has cut the rating on the stock as well. Indiabulls twins, so Indiabull Housing Finance as well as Indiabulls Real Estate, these are the 2 stocks which are in focus. Indiabull Housing Finance is down 3%. However, Indiabulls Real Estate is one stock which is in focus, up for second day in a row in double digits, has come off the day's high but still up 9% on Indiabulls Real Estate. Bharti Airtel, Ultratech Cement and Adani Ports are the stocks which are also in focus. All of these stocks are top losers on the Nifty at this point in time, down anywhere between 1 and 1.5%.
Ethan, thank you for that. CLSA has turned bearish on Asian Paints as oil prices rise sharply. The brokerage house downgraded the paint maker to sell rating. Meanwhile, Asian Paints also reported a fire at one of its units. Yash is standing by to tell us about all these developments. Yash.
That's right, Harsha. Asian Paints is in big pressure today, down about 3.5%. The news that came out yesterday post-market hours was the fact that one of their plants in Andhra Pradesh, which has a total capacity of about 500,000 kiloliters per annum, has had a fire incident and has had to shut down all of its operations. It is one of the largest plants for the company, and it was only recently commissioned for a total investment of about 1,800 crore rupees. The management does not give out any specific details with respect to what would be the production loss, but they have mentioned in their press release that it would be impacting their manufacturing activity in the quarter. As far as the CLSA downgrade is concerned, there has been a double downgrade coming in. First of all, they have downgraded the rating from outperform to sell and have cut the target price as well from 1,565 to 1,400 rupees on the counter. This they have cited on a couple of reasons, primarily the fact that the weak macro data with the expectation of a slowdown in the GDP, as well as a negative commentary coming in from consumer staple majors such as HUL with respect to volume offtake, that would remain a big overhang on the company. That too coming at a time when crude oil prices are at record high. $72 per barrel, that puts pressure as far as their margins are concerned in the near term, and the fact that the valuations they continue to trade at a premium are some of the key reasons that they cite for the downgrade. But not just Asian Paints, some of the other names too continue to be under pressure. Kansai Nerolac down about 3% as well as Berger Paints, which is down about 1.5 or 2%.
Yash, thanks so much for that. Larsen & Toubro may be poised to meet its order inflow target for the first time in 6 years. Not only has the infrastructure giant maintained guidance this year, but the order announcements in the March quarter indicate that the company may even exceed its projections. Darshan Mehta joins us with the math. Darshan.
So what happened was L&T came out with its guidance last year. So for the past 6 years, they've been cutting their guidance. This time around is different because not only have they not cut the guidance, it seems that they will exceed the guidance. So the 10 to 12%. So what happened was the total orders that they got last year was 1,53,000 crores. So the target this time for a 10% growth was 1,68 to 1,71. How much they have bagged till now is 1,20, which means for a 10% growth, they will have to do close to 47,000 crores, 48,000 crores of orders. And for a 12% 10% growth, they will have to do a 51,000 crore. So that's the math that they have done till now. What they have done as of now is that from the fourth quarter, they don't give any kind of value. They just give bucket sizes. So orders between 1,000 to 2,500 crores are significant. Similarly, large, major and mega. And any order below 1,000 crore, they don't disclose. They disclose it at the end of the quarter with the consolidated numbers. So the orders that they've got this time around include a lot of orders from the hydrocarbon space and the construction space. So this is a large order that they got from the hydrocarbon space, 2,500 crores. So these are the orders that they have managed to receive. A mega order, this was an order that they received in the hydrocarbon space. The mega order, another construction order for a construction of an airport, 7,000 crores. So they've been bagging a lot of major as well as mega orders, which have actually helped them as far as their order book is concerned. So this is it. Another large order that they got here was the construction order, significant order. So they have. So this is basically the broad range of orders they've got. Now, if you total what happens, if you take the total, the minimum of the orders, if they got you got 42,000 crores. The maximum is 70,000 crores, which means that the guidance has been beaten. And the analyst community and we have taken an average, which is the midpoint, which is close to 56,000 crores, which means that the guidance has been beaten by L&T this time around. And this does not include the smaller orders in terms of the less than 1,000 crore. Majority of orders have come in the hydrocarbon, building, water and T&D space, and that is where they have got it. A lot of international orders have come in. Central government orders have not come in, but international orders, state government orders, PSU orders is something that have done well for L&T this time around. Now, if you take a look at the order book, what is there? They've done close to 47,000 crores. That was in the third quarter FY17. But this time around, if you take the average, it will be the highest orders that they've managed to bag in a quarter. So that is something that they've done well. And on the maximum front, it will be close to 70,000 crores of orders that will come in. So that's the broad trend. What have analysts said in terms of the order inflow? JP Morgan believes that they could do orders of almost 70,000 crores this time around. CLSA and Citi, based on the order calculated, believe that it will be close to 55,000 crores, which still means that L&T will beat the order inflow guidance and post the highest quarterly run rate for any kind of order inflow that they've done till now.
Darshan, thank you for that. Let's move on. Cement makers have posted healthy gains over the last 3 months, and it's not only because construction activities has picked up in the last few months and that consequently that has pushed up prices. In fact, this year the price rise has aided regional players more than their bigger peers. So what's working in favor of cement makers? Nikki is standing by with some factors.
Hi Harsha, if you look at the pan-India players' stock prices, that's a 10-15% uptick that we've seen on YTD basis. But then if you compare the math or compare the returns that we've seen of regional performance, that's a tad higher, anywhere between 15 to 30% for something like the likes of India Cement, Ramco Cement, Orient Cement. They're all south-based companies. Getting on to the math first, or the factors which are driving the growth out there for cement players, we have the abating cost pressures, where if you look at the list here, we have 4 components which go behind that: lower cost, a better realization on account of higher price hike, and positive commentary coming in from the market leader Ultratech Cement. Let's address the lower cost a bit first, where the domestic petcoke prices along with the imported coal prices, these are the 2 components which go behind the power and fuel mix. They've been abating. 7,617 rupee per ton is what the domestic petcoke price is currently. That's a decline of around 13% sequentially and a 5% decline YOY basis. Clearly you could see the moderating cost pressures here, and even for imported coal prices, we're looking at a 12% decline both on year-on-year basis as well as sequentially. Apart from that, you have the freight rates which are now also on a declining trend. Now remember, power and fuel along with freight rates together contribute to around 50% of overall cement industry cost. Let's look at the diesel prices, because most of the cement players carry their cement on through most trucks method, which use diesel. 68.5 rupee per ton, per litre is what the price is right now. That's a sequential dip of around 4 to 5% year-on-year basis. The prices have somewhat remained consistent. Morgan Stanley in its report suggests that the change in axle norms is expected to bring down the freight cost and lead to a saving of around 3 to 4% for cement players. Apart from that, we are also looking at the pricing power. We've been talking extensively in the last 3 to 4 months about how these cement companies are going going ahead and taking the price hike. As you can see in the chart out here, for 3 consecutive months, we've seen a price hike coming in for cement players across India basis, which in turn is expected to show in terms of the realization for this quarter. Also, we're looking at bullish commentary. We saw a bullish commentary coming in from UltraTech Cement in its Feb 2019 investor presentation. From there on, we actually saw the rally coming in. In its investor presentation, UltraTech suggested that it sees demand surpassing that of supply, because the capacity addition is to the tune from FY18 to FY21 is to the tune of around 52 million ton, whereas the requirement of demand of cement is to the tune of around 87 million ton. On account of these factors, we're seeing a rally coming in on cement stocks. Back to you guys.
All right, Nikki, thanks so much for that. Residential builders are finally seeing some demand for their houses, and that's reflecting in their stock prices. Almost all the top contributors to the Nifty Realty Index have been builders with a sizable residential portfolio over the last 6 months or so. Sharad Dubey is here with us to take us through the details. Sharad.
Yes, Ira, the Nifty Realty Index has gone up by almost 34% in the last 6 odd months. This is basically the main contributors being Godrej Property, which has almost doubled up, and also Prestige Estates, Oberoi Realty, Brigade Enterprises, and all of these players who have a sizable residential presence have gained over this period. Now, Q4 updates have come for 2 companies. The first one being Sobha Properties, which have posted its best quarterly performance in terms of residential sales, increasing almost 8% on a year-on-year basis, and also breaking the 1 million square feet mark for the first time ever in terms of new sales volume. Now, moving on, we see Godrej Properties, whose booking value has almost doubled to 2100 odd crore rupees, rising almost 3 times to 3.75 million square feet for the March quarter. Even steady sales has been seen for the second half for the financial year. Recently, the report has come out from Anarock, which has actually shown an uptick in the demand in the economy for your residential units. That is almost up by almost 51%. So basically, what is working out for the residential developers? So basically, first we see over the last few months, there has been a tweak in GST, and also there has been an option to avail the input tax credit for the developers. Even the revenue will also look chunky for the financial year 19, because the builders can now recognize the revenue for these projects on a completion basis under the new accounting norms. And finally, RBI has come up with a rate cut, and this would actually ensure lower interest rates for the home buyers.
But isn't it too early to call a complete bounce back?
Well, it is. The other side of the coin, there is definitely the industrial space. I mean, the residential space is suffering from an inventory hang. Barring Kolkata, almost all the markets have seen a high jump in new supply of residential units. Where astonishingly, we see Pune's new supply going up by almost 538 odd %, while NCR and Mumbai's have also increased by around 77 to 183 odd %. One more thing I would like to point out is around 4.5 lakh crore worth of housing projects are still stuck in the top 7 cities as per Anarock's report. Now, there are a lot of multiple headwinds coming up in the industry. The first one being the residential builders' supply has outstripped the demand for all the cities, and the housing sales, they come at around 58% to the new supplies of around 91 odd %. And one more thing I would like to point out is the affordable housing segment. Only 44% of these new projects are actually being, used for the segment. So this actually rally which we have seen in the last 6 months, Harsha, has actually increased the valuations of the companies. So this residential players' price to book value ratio is currently trading above the 5-year average moving average for the P to P/BV ratio. So this is what it is.
All right, Tasha, thanks so much for that. Let's move on. India's just got its first gaming unicorn. IPL Fantasy League portal Dream 11 recently entered the $1 billion club when 2 of its existing investors sold part of their stake to a Hong Kong-based company. Nishant Sharma now joins us with the details. Nishant.
Well, right here. I mean, it's basically raining unicorns this year, and after Delivery and Big Basket, Dream 11 become the first gaming unicorn and the third unicorn startup to reach the unicorn club or startups valued more than $1 billion. Now, this sudden spike in valuation of Dream 11 came after the secondary sale purchase in which Steadview Capital, the US-based investor in Hong Kong and US-based investor, purchased part of some bit of shares from existing shareholders such as Calorie Capital, multiple alternate asset management and Think Investment. Now, while the company did not disclose the exact valuation, quite one person privy to the development The startup is valued a little short of $1.5 billion, and this spike in valuation comes just 8 months after Dream 11 raised a round of about $100 million from China's Tencent, and was around that time it was valued about close to roughly $600 to $700 million. And also, this spike is also seen just months after Dream 11 won a 4-year exclusive contract with IPL as part of the partnership.
Nishant, thank you for that. Let's move on now. Extraordinary measures taken to stave off the financial crisis 10 years ago have central bankers stuck in a tough spot today. How do they get out of this low interest rate environment without toppling everything that they worked for in the past 10 years? BNN Bloomberg's Greg Bonnell asked that question to former RBI Governor Raghuram Rajan in Toronto, and he argues that the longer central banks wait to get back normalcy, the tougher it's going to be.
We seem to be a world economy with just one instrument, which is interest rates. We've pushed them to rock bottom. Asset prices are elevated. There's a lot of credit out there. And it seems as if we start raising interest rates, everything starts backing up. That's what we saw last year as the Fed said, we're going to raise interest rates steadily. And what happened? End of the year, with the trade tensions, of course, coming to boot, suddenly it seemed as if world growth was falling off a cliff. The Fed has backed off, I think rightly so, but it does leave the question, are we stuck in this environment forever?
And the big question, too, and I know we're grappling with this country, and I know others are, this idea of what a neutral rate is, what normal looks like. And maybe it's not the normal that we knew in the 80s, the 90s, the 70s. Maybe things have changed dramatically because of what we suffered through 10 years ago.
Well, it certainly seems to be the case that we require a lower real interest rate to get the kind of economic activity that we want for full employment. But it also seems as if we stay with a low interest rate environment, a lot of other factors come together to prevent us from ever raising rates, because you have credit, you have asset prices, and as soon as you start threatening to raise interest rates, they start making noises on that side, and it becomes harder to raise interest rates. So we may effectively be creating more of a trap for ourselves. Only time will tell if we have other exogenous sources of growth. What is perturbing is global growth is so weak after 10 years of one kind of stimulus or the other.
How concerned should we be, and the bond market had us concerned about the next recession? I think of in terms of making progress for society, and then cyclically another recession comes and all the good intentions get thrown out the window as we battle for it. You were one of the few economists, I understand, who actually predicted the last one. What do you think the dangers are for the next one?
Well, they always think you can do it again, right? Once you're lucky. Yeah. Well, really, I think right now what we have is fairly weak global growth. And policy uncertainty is adding to it, right? The trade imbroglio between the U.S. and China is creating uncertainty about investment. Why would I put any new investment in the ground when I don't know if my competitor is going to either have a 20% cost advantage or a 20% cost disadvantage, depending on where they locate? So trade uncertainty is creating havoc, whether it's Brexit, whether it's the U.S.-China issues, or whether it's even which country is going to stay within the European Union or within the euro area. So my sense is some of the policy uncertainty is putting a dampener, that the extremely accommodative monetary policy is not able to lift us out. What we do need is certainly policy uncertainty to seize a strong U.S.-China trade agreement will help. Some of the stimulus that has been put into the system in the early part of this year, Chinese fiscal stimulus, as also the monetary stimulus from the Fed backing off from the interest rate hikes, I think will also help. My sense is later in the year, provided policy doesn't turn abruptly, which it could in this era of strong leaders, my sense is later in the year we should be better off than right now. And I think even with the U.S. fiscal stimulus coming to an end, we probably still don't have recession facing us directly, at least over the course of this year.
This era of strong leaders, you just said. It makes me think about Donald Trump, his populism, and the amount that he's been leaning on the U.S. Federal Reserve, which, of course, is supposed to be independent of politics. Is this troubling? He's recently on their case again. Now I'm saying, oh, it's good that you stopped the rate hikes. Now I want to see a cut and some quantitative easing.
I think we have strong leaders across the world who think they represent the will of the people, and the will of the people is paramount, much stronger than the institutions. And many of these leaders haven't really understood the rationale for these institutions, which were very important to create the kind of growth we've had. So One of the things we've learned to do is leave central banks alone. They do unpopular things, but that's good in the longer run because it keeps inflation low, it keeps growth more stable than it would otherwise be. The problem of jawboning the Reserve Bank, the Federal Reserve, is it could have one of two things. It could either put their back up and they say no just because you're jawboning, even if the economy needs more accommodative policy, or it could do the opposite with equally devastating effect. They succumb, and then the view is these guys are poodles, and therefore when inflation actually shows up, they will not do what is necessary. Both outcomes are problematic, which is why leaders have stayed away from commenting thus far. I think the Federal Reserve has a political issue on its hands and will have to deal with it as best as it can.
I wanted to round out the conversation by talking about India, emerging markets, and the emergence of a new middle class in other areas of the world. Of course, in the West, the middle class is very well established. What kind of challenges does that pose for central bankers in other countries as they emerge, and people who never would have been considered middle class are now buying homes and cars and phones and everything else?
Well, there's a challenge, one of expectations, that the expectations are really high. They see on TV all these homes that other people are buying. Everybody wants that kind of income. So you need to create jobs. One of the biggest issues in front of India today is, can we create enough jobs for the 1 million people who are coming into the labor force every month? So that's a
every
huge,
month.
Every month.
Wow.
It's a big country, and so that's a huge challenge for any government that's in power. But also, as we're growing, we have precisely the same challenges as we have today in the United States. How do we build those institutions that are needed for growth? And how do we tell people that sometimes the role of these institutions is to say no, to stand in the way of policies that seem obvious, cutting interest rates, for example, just because it's good for the economy in the longer run?
All right. US President Donald Trump is contemplating retaliatory tariffs on helicopters, motorcycles, cheese and wine from the European Union. He claims the subsidies to Airbus is causing harm to Boeing. Bloomberg's Derek Swalberg reports.
Well, the USTR has put out a list of about $11 billion worth of products. The lead headline of those is Airbus planes, although this is a broad list that also includes things like wine and British Stilton and French Roquefort cheeses and things like that. So it's a broad group of things. And the U.S. is putting out this preliminary list in response to what they say have been decades of Airbus Airbus subsidies, I should say, on their planes, including launch subsidies that help Airbus get brand new planes like the long-distance A350 off the ground. This is a long-running dispute between Airbus and Boeing, the U.S.'s #1 plane maker, and the U.S. has said quite clearly they think that this is enough of that. The WTO is going to make an estimate of how much the damages may or may not be, theoretically by sometime this summer, maybe end of summer, and so the U.S. is going to take that as sort of the overall amount that it's using here. But what it's done right now is put out a list of 11 billion worth of products that it's ready to go with as proposed countervailing duty targets.
UK Prime Minister Theresa May will head to Brussels today to seek a further extension to the Brexit deadline. The European Union had earlier granted a 2-week extension from March 29th, but with no deal in sight and the Parliament voting to block a no-deal Brexit, they're going to need more time. Jody Schneider reports.
It really is a formality because she is all now about the extension and how long an extension, well, what kind of extension, what kind of deal can she get from the EU, given that this April 12th deadline, everybody agrees the UK does not want to leave on that date. So at this point, she's going to be meeting in what they're calling coordination meetings that are happening in Brussels. She will be meeting with the German Chancellor Merkel and French President Macron about this, and then there will be a summit later this week with all 27 remaining EU countries about what kind of offer they are going to extend to the UK. Meanwhile, some in her own party are trying to throw her overboard while all this is happening. So there's a lot happening here, but it is the conversation right now is all about the extension.
What kind of extension and the terms within that could be offered to May?
Yeah, that's the real question on the table, Heidi. Partly it's about timing, right? And they're talking about it being perhaps as a long period, a longer period, but it could be anywhere. What we're hearing now is from June 30th of this year, perhaps as long as April 1st of next year, of 2020. And the terms are also a real issue. While at this point, one of the things that the countries are talking about, the member countries of the EU are talking about, is that they would, May and her and Parliament would agree not to disrupt the EU in any way, which would certainly mean that they would have to vote in next month's European Parliament elections. Some, including France, want tougher conditions. They want to make sure that there will not be a disruption of the EU by the UK, which has clearly been wanting to leave. So it's a delicate process, and all 27 member EU countries have to agree at that summit later this week on what that offer will be.
Out of time on the show. Thank you so much for joining us.
Lots more coming up. Stay tuned.